On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi, team. Hope you're all well. Let's take a look back at last week. Then we will talk about some of the things I'm keeping an eye on in the week ahead. Last week was a strong one for equity markets in most parts of the world. Japanese shares were up 0.6%. The Australian market was 1.3% higher. Europe added 1.4%. Emerging market shares gained 1.2%, and the local NZX 50 rallied 1.5%. That was our best week in 6. The S&P 500 in the United States, however, fell back slightly. It was down 0.3%, which is only the third down week we've seen since October last year. And before last week, the S&P 500 had increased for 16 of the past 18 weeks. And that's a feat we haven't seen from the US share market since 1971. So if it had have gone up again last week, that would have been the first time it's recorded 17 up weeks out of 19 since 1964. So a couple of records there to ponder. The index has still started very, very well, even though it was off the boil a little bit last week. In comparison to other markets, the S&P 500 has risen 7.4% so far this year. So a very good return. And Japan, I think, is the only market that has been stronger than that. Japanese shares are up about 15% this year. So the US and Japan were the two strongest markets in 2023. And this year so far has gone the same way, with those two being two of the strongest around the world. US interest rates fell back slightly. The 2-year Treasury yield ended the week at 4.47%, and the 10-year fell from 4.18 to 4.07%. Similar story in New Zealand. Our interest rates were down too. The 5-year swap rate finished the week 13 basis points lower at 4.38%. That's the lowest in about 5 weeks. And markets have moved to price in a greater chance of an OCR cut coming over the next several months. At the moment, market pricing suggests there is a 33% chance of a cut in July, so about a third, and that rises to an 83% chance by August. So markets are starting to think August is the time when we will see that OCR cut. The Reserve Bank, obviously, in its forecasts, is still saying middle of next year. So there's a big difference between middle of next year or even early next year and August this year, but that is where markets are at. So we will monitor all the data and the economic indicators we're seeing to watch those expectations change. Looking back on some of the key releases from last week, locally, we had dairy prices. In the GDT index, the Global Dairy Trade Index fell 2.3%. That's the first drop since November. The GDT index is still up about 6% this year, and it's still about 27-28% above the August lows. And Fonterra obviously bumped up its milk price forecast not so long ago, increased it from $7.50 to $7.80 at the midpoint. So I think even though you've seen a bit of a drop at last week's option, I would say that is still fairly safe. Also, last week, we did get some of our GDP partials, some of those other economic indicators that feed into the GDP report, which is out next week, I think, on the 21st, if I remember correctly. These were a little bit mixed, so I think that sort of fits with the feedback I'm getting from around the country, talking to whether it's accountants or business people that are at the coalface on the ground. There has definitely been a slowing in the economy over recent months. So that GDP report will be very closely watched, and if it is on the soft side, I think that will probably firm up market expectations that we could get that OCR cut over the second half of this year rather than in 2025, as the Reserve Bank is suggesting. Offshore, what did we see last week offshore? The key release was the US jobs report. This was for February. A bit of a mixed bag, something for everyone. So if you're in that a recession is coming camp, then there was something for you in this. If you're in the soft landing or the no landing camp, there were things you can latch onto as well. So it definitely was a bit of a mixed bag. We saw 275,000 new jobs created, so that's good news. That's above forecasts. Forecasts were for 200,000, so quite a beat in that sense. However, the gains from the previous 2 months, you might remember that the January figures were really strong. I think they were initially reported as 350 odd thousand, which was the highest in a year. Those were revised lower. So you look back over the last couple of months and things don't look quite as strong as people thought when that first release came out. We also saw the unemployment rate rise slightly. It increased to 3.9%, which is above expectations. Expectations were for it to be unchanged at 3.7. So instead of staying at 3.7, jumped up to 3.9. That's the highest in a little over 2 years. Still quite low in the context of history, but the highest we've seen in a couple of years. The underemployment rate, which is a broader measure of labour market slack, it picks up things like people working part-time but they want to be working full-time, or people that aren't getting as many hours as they want. So it's actually a better gauge of where the labour market is at. It increased too. It rose to 7.3%, and that's also the highest since early 2022, so the highest in about 2 years. There was some good news on the inflation front. Average hourly earnings rose just 0.1% during the month. That was below forecast for a gain of 0.2%, and average hourly earnings increased 4.3% on an annual basis, which was in line with expectations and was down slightly from January levels. Other things that we saw last week out of the US, while we're talking America, we saw Jerome Powell's testimony to Congress. So he talked to the House Financial Services Committee on Wednesday, and then the Senate Banking Committee on Thursday, I think it was. And long story short, he said that he expects interest rate cuts this year, which is what the Fed's been telling us for the last few months. So that's nothing new there. They still weren't quite convinced that enough progress had been made towards their inflation objective, which is for 2%. So they still wanted to see a little bit more evidence there that things were, in fact, moving towards that 2% target, and that they won't cut interest rates until they have that confidence. So, yeah, I think that's more of the same. We'll be watching the CPI report in the US this week. I'll talk about that when we get to the what's coming up section. But that Powell testimony really just did confirm where markets are at, that a cut is imminent. It's happening this year, probably in the next few months, but at the same time, the Fed just wants to see a little bit more evidence that inflation is heading towards its target. So we're probably not going to see that cut this month or even next month. It was also a big week for US politics. We had Super Tuesday, some of those primary elections, and now it looks all but official that we have got the Biden versus Trump rematch that we've all been expecting. If you want to know more about that, a week or two back, I did record an episode and I wrote a report to go along with it on the US election, what it might mean for share markets, what we can learn from history. So go back and take a look at that one if you missed it. That was quite an interesting one. Across the Atlantic from the US, we saw the ECB meeting. They left rates unchanged. The European Central Bank, their policy rate is at 4%. That's the highest we've seen since the euro came into being in the late 90s. And that was as expected. No one expected them to hike anymore. No one expected them to cut either. So that was in line with expectations. They've been on hold since about September last year. Rate cuts are looming, though. We've seen good progress on inflation in Europe. The headline inflation rate's down to 2.6. That's what we saw in February. That's the annual pace of inflation. So that's the lowest since the middle of 2021. And as such, the ECB did revise down their inflation forecasts for the 2024 calendar year. They were at 2.7% before. Now they're at 2.3%. So they're getting pretty close to where they want to be in terms of where they see inflation headed. They did downgrade their growth forecast too. So, that's typically how things work. You can't have your cake and eat it too. If you're going to put in place more restrictive monetary policy settings that will limit inflation, then you usually have to pay a bit of a price in terms of economic activity and growth. And that's what you're seeing in most economies here in New Zealand and obviously in Europe too. But anyway, the next move from the ECB is expected to be down, and the June meeting is seen as the most likely timing. Markets are close to fully pricing a cut in June, and they've got four 0.25% rate cuts priced in over the 2024 calendar year. So June's still very much seen as the most likely timing for the Federal Reserve in the US and the ECB in Europe to cut rates. And here in New Zealand, as I mentioned earlier, August is what people see as the most likely timing. So we will be a little bit slower, one would think, than some of those other bigger economies. The other thing from last week was the National People's Congress in China, and as expected, they set a growth target of 5% for this year. That's the same as last year. A few people think that could be a little bit ambitious. China still has a lot of challenges, so maybe 5 will be a tough ask, but we will see. There was a few other measures that were announced to help tackle the slow recovery from the pandemic that we've seen in China. So new initiatives to try and sort out the property sector, which is in a bit of a crisis, and also to add jobs in urban areas. Regulation of financial markets, that's something they're looking to increase, and research in AI, life sciences, new technologies. So largely as expected in terms of what we saw out of China with the National People's Congress last week. Right, turning to the week ahead, the key thing I think across the world will be the US CPI report, the Consumer Price Index inflation report for February. That's out on Tuesday in the US, so it'll be overnight Tuesday, and we'll see it Wednesday morning. Remember, there's a few different inflation reports that you get in the United States. You get this one. You also get the PCE inflation report, and it's the PCE inflation report that the Federal Reserve watches most closely because it believes that that report is the one that is the best gauge of where the true sort of pricing pressures are. But this one is still very closely watched too, the CPI report. This will be for February, and listeners will remember that about a month ago we got a hotter than expected release in January. So markets are bracing for potentially more evidence of inflation pressures being more persistent than hoped. Remember, it was that super core inflation, which is when you're really zoning in on some of those core inflation measures. That was what got all the attention a month ago. This month, people are expecting the headline CPI to rise 0.4%. That would be the highest since September. And the core CPI is expected to have increased 0.3% for the month. So when you look at the annual rates of inflation, that would see the headline inflation rate unchanged from January at 3.1. So kind of getting a bit stuck in the low threes when they want it to be coming down a bit further. And core inflation would be coming in at 3.7%. That's what markets are expecting, at least. And that would be down from last month. That will be the lowest since April 2021, heading in the right direction, but still you're in that territory now where it's starting to get a little bit harder to get inflation down to the levels where we want it to be. So progress has been slow on the inflation front, at least based on this measure, and the annualized 3-month average of the headline CPI has recently re-accelerated to 3.7%. So that's sort of what is keeping people a little bit nervous, and I think that's why this will be closely watched. It's also the last major release until the next Fed meeting, which is next week, next Thursday morning, I think it is. No one's expecting any change in the policy settings. The next move for the Fed is down, but we won't get that next week. That's something for a little later in the year. At the moment, pricing implies about a 25% chance of a Fed rate cut in May. And that increases to more than 90% by June. So June very much seen as the most likely timing. 4 rate cuts expected this calendar year. That's one more than the Fed has in its numbers, but this CPI report could change some of that. So it's quite an important one because it's the last big one ahead of when we hear from the Federal Reserve. That will be what we're watching most closely in the US. What else we got in the US? We've also got the consumer in focus because we've got February retail sales and we've got the University of Michigan survey also due. And there's more on the political front too. Presidential primaries will continue for both parties. It looks like it's going to be Biden versus Trump, but those will still get some headlines anyway. And at the end of this week, while we're talking politics, we've got the Russian presidential elections. I think they take place from Friday to Sunday, and Russian elections, that will be a close one, won't it? A real nail biter, one would think. In New Zealand, we have got a housing market report. That's probably the thing that I'm watching most closely. I think this is out on Thursday morning, 9 a.m. Might be Wednesday, might be Thursday, probably Thursday, if I had to guess. Been a bit of a slow start to the year for the housing market. January, always a quiet month, but saw a Westpac report that said it was the second lowest level of sales for a January in 32 years. So it definitely was a little on the soft side. The days to sell increased in Auckland, fell elsewhere. Volume's pretty low compared to what you would expect to see, and house prices pushed up a little bit, but still fairly subdued as well. So I think the housing market has stabilised, but you've still got affordability issues. You've still got high mortgage rates. You've still got unemployment that is rising. So buyers still are a little bit cautious, and you're not really seeing the market take off either in terms of sales activity or prices. So, stability is good, but you're not seeing things rocket ahead. So we'll be looking for evidence that those sorts of trends are still in place when we get that housing market report. Elsewhere in New Zealand, on the calendar, we've got electronic card transactions on Tuesday. We've got the ANZ truckometer, which is a good real-time indicator of where growth is headed and heading and where it's been. We've got another monthly migration report on Thursday as well. And on the corporate front, we have a couple of things to watch here and across the world. Briscoe's reporting their full year earnings, and I think that is on Wednesday. And then not much on Australia, but elsewhere, Oracle got an earnings release on Monday. Wednesday, we have Adidas, Dollar Tree, and Volkswagen. And Thursday, Adobe. That'll be an interesting one. Adobe, great business. And has gone okay of late, so that one will be worth watching too.